Real Estate Talk is provided for general information only and should not be treated as a substitute for professional advice. Please consult your trusted financial advisor, real estate professional, or attorney before making any real estate or financial decisions. Please remember, when following advice, your results may vary, and all information covered here is not intended to cover all aspects of the subject material, but rather a sample of issues the hosts and guests consider important. And now, Real Estate Talk with your host, Victoria Rivadeneira. Each week, Victoria gathers some of the best minds in the business to provide both professionals and non-professionals with the inside tips and tools to make smarter deals. Whether you're a buyer or seller, Real Estate Talk will give you the competitive advantage you need. And now, here's Victoria Rivadeneira.
Here is not Victoria Rivadeneira. This is J. Philip Ferranda sitting in for Victoria here in the iHeartRadio studios at 710 WOR. I am joined by Lior Aldad, our resident attorney, and our guest Don Giorgio, who we will meet shortly. We stream live on Facebook, and we also are able to be seen at retalkradio.com. Lior, how are you today?
All right, fabulous.
Fabulous. And I'm going to dive right into this because we have a really interesting guest. I am joined today and happy to welcome Don Giorgio, who is the president of United Northern Mortgage Bankers. He is a New York guy through and through, lives in Massapequa in the same neighborhood as most extended family, but he tells me that we do not have Spaghetti Wednesdays. We
have Pizza Fridays, not Spaghetti Wednesdays.
Okay.
I remember Pizza Fridays.
We have Taco Fridays. But, I guess there's a double-edged sword by having family live nearby.
There are no secrets.
That is for sure.
No secrets, but you don't have to go grocery shopping as much as you might think you might have to.
Yeah, absolutely. So, Lior, what do you need to buy a house or a property? What do you need first?
Well, I think there's no doubt that you need to have the proper financing and the ability to finance the property. And before you can go shop, you want to be able to look for a good lender, somebody who, assuming you need to borrow, and a good broker.
Yep. All right. So you need the dough. You need the money.
Absolutely.
And most of us are not walking around with enough money to pay cash for a house, so we got to go borrow it. And the best thing to do is go find, like you just said, a good mortgage banker. Local expertise, somebody knows what they're doing. We happen to have that very type of company here. Don, welcome to you. And
thank you.
Let's talk about this stuff. There's a lot going on that are changes in the industry. Can you give us sort of an overview of, actually, before we get into that, people need to know that there's different types of loans, right?
Correct.
So there's a regular conventional loan, which is sort of what we're going to talk about today.
Right.
There's starter home loans, which are sort of like
first-time home buyer loans.
Right. That's sort of like FHA.
Yeah.
There are something called jumbo loans, which we'll talk about just a bit. But really what we want to dive into is the conventional mortgage.
Correct. Conventional financing.
How would one define that?
First, thank you for having me here. I appreciate it.
I'm glad to have you.
I got somebody that has to listen to me now for an hour, so you're
right.
stuck. It's good.
It's good. It's good to be stuck. I was just on the subway, so
right.
I'm happy to hear
Captive
that.
audience.
Yeah.
So conventional financing. We'll talk about it a little bit. There are different types of lending, but predominantly about 67% of the nation or so, 65% of the nation uses conventional financing, as opposed to the other type, which is basically FHA financing, government insured.
Aha.
So bulk of the public is going to go with conventional financing, which goes lending limits up to about $417,000.
Okay.
And just to clarify, conventional, we're talking about a 30-year fixed versus an interest only?
No, not necessarily. You can have an adjustable rate on a conventional loan, but not interest only.
I see.
Okay. Conventional financing means typical standard financing, nothing out of the ordinary, just run-of-the-mill financing. And some people might have heard the terms Fannie Mae or Freddie Mac along those lines.
Bingo.
Yep.
Okay, so that's when the red light comes on. Fannie Mae and Freddie Mac are actually the nicknames for these acronyms, these federal government, quasi-government.
Right.
We call them GSEs, right?
Yeah.
Government-sponsored entities. And how do they work? What is their place in this?
They're basically the pool of money that we all go to when we want to lend you money. We're going to sell our loans for the most part. Mortgage bankers, the mortgage industry. You might hold on to your loans. You might sell the loan. But in most cases, that's where we go to get our money to put the money out on the street. Would be Fannie Mae or Freddie Mac.
Mm-hmm.
So they've come up with all of the lending criteria that we abide by in order to grant the public its loan to buy their dream home.
Is that unlike a bank saying that we hold on to the loan?
There are banks that do portfolio lending.
Okay, can you elaborate?
They may have different types of criteria from what the Fannie Mae or Freddie Mac agency criteria is.
I see. And they hold on to the loan in essence.
Yeah, they may hold on to the loan. Again, they may sell it at a later date depending upon their needs for funding.
So the consumer out there may not understand. What do you mean hold on to the loan? What do you mean sell the loan? So I have a mortgage. It's Bank of America.
Correct.
Okay. I didn't go to Bank of America to get my mortgage.
Right.
I went to some local bank, and they funded it at the table.
Correct. They funded the loan at the table.
Right, but they don't service it.
They may or may not service it
Right.
at some point in time. Let's say the lender put out $417,000.
Mm-hmm.
They may decide we don't want to wait 30 years to get our money back. We may decide at a certain point in time we want to get that $417,000 back so we can go lend more money. So we're going to take that loan and sell it off so we can get our capital back working.
Okay, that makes plenty of sense.
Yeah.
And they'll let you do that.
Sure. And then Bank of America may buy it. And then at some later date, Bank of America may say, you know what, we don't want to keep this loan. We want to have the cash for it. And we'll go sell it to another bank.
I think it's important to clarify, and I have many clients asking me at the table, if my bank will sell my loan or if my bank will give my loan to a servicing agency, will that affect the terms and conditions of my loan? And the answer is no. Your rate, your terms, your conditions in no way, shape, or form gets affected or changed.
Correct.
But rather, banks among themselves sell the loans to each other, sell the loan to the government, or hire a servicing company that will cater the needs of the bank and service the loan.
So, yeah, some consumers are traded like trading stamps,
Correct.
With the mortgage asset that it is. They just have to be mindful to be on top of it because in the case of a loan being sold, the servicer may lack in time in preparing the client properly, and checks do get lost. So they've got to be on top of their servicer, whoever they're mailing their payments to, and make sure that they get appropriate credit for mailing payments in.
Is that why we sometimes run into people who say, I don't want my loan to be sold? There's this peculiar ethos among some consumers where they think if my loan is sold, it's bad.
Well, if your loan is sold, you're not worth any less or more than that loan.
It's the same loan. You're going to write the same check. You're going to. It's the same interest rate. It's the same everything. It's just where you mail it to or who you write it out to, but it's really the same thing.
Yeah, your loan terms, as Leo said, they do not change. They stay the same, and you're just mailing your check or automatic checking account deduction is going to go to a different entity.
I would also say it probably goes pretty common. Not everybody pays the same mortgage for 30 consecutive years to the same bank because the banks buy each other, right?
Right.
I had a mortgage with Washington Mutual. Then it became Chase because Chase bought Washington Mutual.
Yeah.
Right. And we say bought with air quotes, but okay. We won't go
shotgun there. Wedding.
Yes,
that's what we say.
It was a shotgun wedding.
But your payoff letter and your payoff amount will be different. In other words, if you are selling your house or you want to pay off your loan, you got to pay it off to the last owner of the loan.
So here's a part that's important for most consumers to listen, and they've got to listen to this. When the loan is traded or sold, like a trading stamp, and it goes around, and the consumer can't stop that, it's just an asset that gets traded. They've got to take a look at that credit report and make sure that prior loan is showing as satisfied, closed, or transferred to another lender so they don't have two mortgages appearing open in the credit report. We see it happen all the time.
Yeah, we see it also. When we have a transaction where the seller is selling and we have a title report coming in from the buyer side, all of a sudden we see a mortgage that was not satisfied or was not closed, and it appears open. We have to go through the channels and properly get the documents in order to record a satisfaction and omit it from record.
You know what you need for that? You need a good attorney and you need a good title company.
Exactly.
There's a lot of money at stake here.
Oh, and it could delay closings. It could have a lot of effects and issues.
A lot of stress.
Sure.
All right. So we are paying our monthly bill. Blah blah blah. It goes to the servicer, and it eventually the thing is owned by Fannie Mae and Freddie Mac. They end up getting the money.
Right. The loan sits with them. They own it. Somebody else may service it because they don't really service loans. It's always the entity that does it for them.
Right.
And then you're still making your payments the same term, same conditions for 30 years or however long you have that loan outstanding.
What else should the public know about Freddie Mac and Fannie Mae?
Listen, they're great agencies that produce the capital that the public needs to go get that mortgage and buy their dream home.
Now, let me ask you this, and this is, I guess, a small diversion. What was their role in the crash 10 years ago, 9 years ago? Were they at fault? Were they victims? Seems to me that they were the cream of the crop kind of loans that were not, like, for example, subprime loans. They had thorough underwriting.
Well, without getting off target, because this is a day-long discussion.
We could talk about it all day.
Over a Moscow Mule, like you said. You
know. So for one saltine.
So for one saltine, everybody's at fault.
Okay, fair enough.
Fannie Mae, Freddie Mac, mortgage bankers, realtors, they all bear blame and responsibility for what happened.
I agree with you.
Okay. Yeah. All right.
I left attorneys out. I hope you appreciate that.
I'm grateful.
Well, you don't want to get sued. Okay. So Fannie Mae and Freddie Mac, they have these underwriting guidelines for a loan, a conventional loan,
right,
to be what we call a conforming loan.
Generic is a good term when it comes down to it.
Regular loan. What does it have to conform to? What are some typical guidelines for a conventional mortgage?
So the way for someone to best describe it is we want you to be generic vanilla. We don't want Rocky Road. We want vanilla ice cream.
We don't want pistachio.
We don't want pistachio. Only if it doesn't have the nuts in it. Then you're okay.
Chocolate chip cookie dough. No, we like vanilla.
Just vanilla.
We're okay with Neapolitan in this room.
Neapolitan can work.
We're good.
I agree.
I think we've got a variety here. Neapolitan works.
Well, this is Neapolitan here, as a matter of fact.
We're getting it there, yeah. I'm a little darker than normal.
Okay.
So the best way to describe it is that they have generic criteria that fits the broadest amount of people, to give the broadest amount of people the opportunity for home ownership to get their dream in place.
So you need a certain level of income. There are certain ratios that are...
certain level of income, certain level of down payment money.
Credit
certain
score.
Credit scores.
Yes.
Absolutely. And that all depends upon the home that you want to buy. So the best way to describe it for a person, the public doesn't know. We have to advise them. We have to be the experts together here and come up to them and say, what did you expect to budget for your home ownership needs? And then we need to tell responsibly that consumer, can you get there with what you want to budget? And if you can't, here's what you can accomplish. Here's what you could do. And that's where we lead into, we had this discussion, what's a pre-approval versus a pre-qualification?
I really want to get into that.
Yeah.
So what is the difference?
It's a huge difference. It's a difference of, did somebody give you 5 minutes, or did somebody really give you their heart and soul and advise you as a consultant?
Okay. I think I want the second one.
You want the second one.
Right.
So you don't want the doctor that comes in the room for 2 minutes and then says you're okay and walks out.
I don't want that doctor.
Full-blown.
No, you want the pre-approval.
No, I want to,
You want the neurologist.
Right. I want...
You want the
consultation.
expert.
Yes.
Yeah.
So that's really... We compile information for a 1003, which is called the application.
Right.
You compile the application, and then you need all the supporting documentation that says what's on that application is what we're dealing with. So that's where a pre-approval involves the expert loan officer who is licensed with an NMLS number, looking at your pay stubs, looking at your bank statements, looking at your credit, and going over any variables that don't meet that generic vanilla ice cream picture.
Okay.
But let me ask you, how long is that pre-approval good for? Can I come back in a year from now and tell you, oh, last year you pre-approved me? Or can you come back to me and say, no, your pre-approval is stale?
Right. Well, if you haven't dated somebody in a year, you're not dating.
I know.
Your relationship is over. You're done.
I gave an extreme example on purpose. But
so even if you didn't go out on a date in 30 days, you're not dating. So somebody that expert should be on top of the situation and be in touch with you. And it really should be 30 days because credit recycles every 30 days. So in 30 days, your credit picture as a consumer can change. So that loan expert should be on top of it. Your pre-approval shouldn't really go for more than 30 days. Once you're in that loan and you're really moving it on, that time frame is extended. It's longer.
Okay, so let me backtrack. So I'm a real estate broker. I have somebody that wants to go look at houses. I asked them, have you been to the bank? Do we are we ready to, do we know what our budget is and so forth? And they said, well, I got a pre-qualification. All right. Pre-qualification is toilet paper.
It's toilet
right?
paper.
Right. You wash your windows with it because it's a 5-minute conversation with somebody who hasn't verified anything, that hasn't looked at anything, that hasn't underwritten anything. And while it is incorrect to say that the underwriting process is not what most people think it is, which is, you think of a guy with like a visor
in the back room.
Yeah. Who's looking at your stuff. That guy, it's all automated.
Very sharp pencil.
Right. like a 1950s movie where the guy, but the underwriting of a mortgage is actually quite automated now. It goes through an algorithm, so they put all that information. You say it's about 2 hours.
Yeah.
To put all the information into the computer program.
The program itself, it's automated from our loan operating system into those what's called automatic underwriting systems, automated underwriting systems. It's an AUS. It's all automatic. It all feeds in. The process that's 2 hours is where that consumer should sit with their consultant for about 2 hours to review all the paperwork. Once that loan officer is there and he got it, he did his good job, stayed awake and asked all the right questions.
Right.
Then it goes into the back office. They'll put it into that generic system, and it's going to tell us through those algorithms what do we really need in order to make that loan happen for the consumer.
So algorithm is like a thing. You can't use an algorithm in law because everything is so specific. Everything is so
correct,
right? You've never done that.
No.
I would be worried if my attorney used an algorithm.
I agree.
No, then
I agree.
They couldn't charge as much as they do. If it was
that would be malpractice.
And I would also not use an algorithm dating.
Right.
They're very cold.
eHarmony tries it. I don't.
Fair enough. So there is sort of a profile that is created by this program.
We're not allowed to use the word profile.
Good point.
Shame on you.
Good point. We don't profile. Cops profile bad guys, but we don't profile borrowers. But the picture of the qualifications of the buyer is imaged. And
sure.
And I'm just keep stepping in it, aren't I?
No, you're doing it. Go ahead.
But it'll look at income. It'll look at debt to income ratios. It'll look at down payment.
Credit
It'll
score.
look at the credit and so forth. And it will come out with yes, no, or maybe, right?
No, there's no maybe. It's going to be a yes or no.
There isn't like a refer, like we need more information?
Yeah, but I wouldn't call that any kind of real status.
Okay.
So that's where you need the human eye to analyze what happened here, what could we do to fix what happened, or we just can't.
Okay, so it's black and white. I did it again.
Yeah.
So yes or no?
Yeah. There's no black or white. There's yellow.
Okay. All right.
But who puts
mocha?
Who puts in the loan amount? Does the machine spits out the amount you can borrow up to, or you put in and ask the machine, can I borrow 7? Oh, no, can I borrow 6? Or can I borrow 9?
Correct.
Which way is it? Is it you inserting the amount desired and see if it was approved, or does the machine say, based on our analysis, you can borrow up to $5 million?
That's the style of the loan consultant to decide how to work it in. A loan consultant may go in and say, let me go to the max and see where these consumers can go, and I might be able to approve a consumer up to $400,000 mortgage, and they really only want $300,000. So it depends upon the style, the consultation style of the loan officer that's with them.
So you can try. So it's a hit and miss, and you can continue trying to.
Well, you don't want to try it too much. That's where expertise has to come in.
That's where you come in.
Yeah, to say, in my best opinion, I'm analyzing your paperwork and I'm eyeing it, and I could see this is the best, sweetest spot for you to be.
Right.
Do you like it or not? If you don't, then I'll move. And then once we're a little certain, because we don't want to play hit or miss. That's someone's life.
Yeah.
You want to go in there with some certainty and be able to tell that consumer, yes, we got it done. Because if you play around too much, here's a little trick of the trade. The automated underwriting system is tracked by the agencies, and if you manipulate it too many times, they see it.
Oh.
Big Brother's watching.
Big Brother is watching, and it's not pretty.
Okay, so the program will give you essentially both answers that Lior asked.
Yeah.
It'll tell you yes or no. But
Correct.
it'll also say you want to borrow $500,000, but your ratios would allow you to go up to 6.
Correct.
Okay.
Yeah.
Make sense?
Yeah, makes sense.
All right.
Right.
Gotcha.
Very useful.
Okay, so that's all good stuff to know. And one of the real emotional parts of this is the credit end. And when we get to the next segment, we are going to talk a little bit about the whole credit aspect, because there are some false beliefs out there, shall we say, among the consumers that we'll talk about shortly. You are listening to Real Estate Talk on iHeartRadio at the studios of 710 WOR. We stream live on Facebook, and you can also listen to our podcasts on retalkradio.com. And we will be right back with our guest, Don Giorgio of United Northern Mortgage.
Hi, this is Tom Marinaro, the president of Residential Home Funding, a top East Coast mortgage company. Now is the time to buy a home before interest rates go up. Lock in with a low rate today, or turn your current home into an asset by cashing in on its equity. Why rent when you can own? Why not get cash out of your home now? So call me right now at 1-800-636-LEND. And as a bonus, if you call me right now, I will waive all of my lender fees. That's right, zero lender fees, saving you thousands of dollars. This offer is for purchasing or refinancing a home. Call me and learn more at 1-800-636-LEND. Residential funding is part of the New York and New Jersey Departments of Banking and Insurance. Our NMLS number is 36152. The number once again is 1-800-636-LEND. That's 1-800-636-LEND.
Do you know what to look for when choosing a title company? It's important to find a provider with years of experience, solid financial backing, and proven expertise on all types of transactions. With Stewart Title Company, you get that. We've been protecting real estate titles since 1893. That long history, along with our sound financial picture, is your assurance of our knowledge and title expertise. Our underwriters are known as being industry leaders. They're responsive, like a good partner should be. And with Stewart Title offices being located worldwide, we can provide title and closing expertise anywhere you need it. Why not let Stewart Title help you close more transactions? Visit Stewart.com to learn more.
Every loan has a story, a family, and a dream that fuels it. My name is Jacqueline Sendra, mortgage loan originator number 39117, specializing in first-time homebuyer financing and an array of mortgage products. We recognize the importance of competitive rates and a custom-tailored mortgage loan to suit your needs. United Northern Mortgage Bankers Ltd. celebrates over 37 years of mortgage banking success. Allow us to help you achieve your dream of homeownership by reaching out to me today at 631-478-2706. Again, 631-478-2706. United Northern Mortgage Lenders Ltd. NMLS number 7230 is an equal housing lender and a licensed mortgage banker located at 3601 Hempstead Turnpike, Suite 300, Levittown, New York 11756, New York State Department of Financial Services.
For more real estate talk, download our free podcast at retalkradio.com. Now back to Victoria Rivadeneira.
Welcome back. This is J. Philip Ferranda with Lior Aldad and our guest Don Giorgio of United Northern Mortgage Bankers. You are listening to Real Estate Talk Radio from the studios of iHeartRadio, WOR 710 AM, streaming live on Facebook and podcasts at retalkradio.com. We were just talking about the pre-approval versus pre-qualification, and we were starting to talk about credit. But before we get into a more in-depth deep dive into the credit aspect of this whole thing, I think it worth kind of recapping.
Sure.
This whole pre-approval versus pre-qualification thing.
Right.
We like the pre-approval.
We love the pre-approval. A
Right.
real estate agent should love the pre-approval. It says that homeowner really needs to go forward. They want to go forward. They're motivated to go forward. And they have, more importantly, all their paperwork ready to go forward. So what does that paperwork really involve to have ready? They should have probably, hopefully, a month's worth of pay stubs. They should have at least maybe 2 months' worth of bank statements for where the money's going to come from for their down payment.
Mm-hmm.
Your tax returns, right?
Your tax returns as well, your W-2s. Have everything ready so that when that loan officer talks to you, you could answer their questions with the backup paperwork to support what you've said. This becomes a documentary of home ownership, not a drama or a mystery of home ownership. It shouldn't be a drama, should not be a mystery. We solve the problems, we answer the questions before they're even asked.
Let me ask you a question. The content of the pre-approval, does it have the loan amount that you're pre-approved for?
Sure.
Does it have the term that you're pre-approved for? A 15-year versus a 30-year?
It should have the term,
Yes.
the loan amount,
Yes.
projected amount of property taxes.
Okay. Carrying costs, right?
Yeah. And an expiration date. It shouldn't really be more than 30 days because credit recycles every 30 days.
Now, what about the type of interest? For example, if I take a certain amount, a certain type of loan, a 30-year fixed, for example, versus an adjustable rate loan, my interest will fluctuate,
Sure.
and I'll be able to afford one versus the other, or vice versa.
Yeah, it's not a shell game or a mystery. That loan office should have on there a rate used to work the numbers out, and that rate should be on the paperwork. What was the rate, the term, and the type of loan product? Was it Fannie Mae? Was it Freddie Mac? Was it conventional, FHA? Right. All that information, which is very important, should be available to the consumer and listed in that pre-approval letter.
So I have two questions.
Yes.
Right? And they both come from what we just talked about. Is it better in some cases to have a 15-year mortgage rather than a 30-year mortgage?
It depends upon your pay stubs and how much money your wife lets you keep. That's a personal question.
So
you to decide.
So to me, it would always make more sense to. I mean, I know there's a lower rate with 15-year mortgages.
Lower
I think,
rate, but higher payment.
Yeah, because you're paying it twice as fast.
Right.
But couldn't you figure out what the 15-year payment would be and just send in extra money on a 30? And that way, if you don't have a good month or something happens, you can still go to the lower payment?
A rule of thumb is if you make one extra payment a year, you're going to cut off anywhere from 5 to 7 years from that loan amount, from that loan term.
Whoa.
Yeah.
I'll tell you a common question that I'm always asked. And the question is, if I mail in an extra payment, will that change my rate because my initial, and the answer is no. It's going to shorten the period but not change.
Yeah. It shorten the period, and it will never change the payment itself. No matter how many payments you make in, your payment's always going to stay the same
but people
until
think,
the loan's done.
Correct.
Yeah.
But people think otherwise, and they think that if I'm going to start mailing more, my principal balance will change, and therefore my future payments will recalculate and rechange.
Right.
And it's wrong. It just shortens the amount of...
So
in 30 years, it can be 25 years, hypothetically.
The consumer doesn't know. They only know what they may have been told. And in most cases, and I'm doing this 37 years, and from talking with clients, because I still speak to clients, I still go in and congratulate them. In a lot of cases, the loan officer that they previously talked to was either not informative or misinformed them.
I agree.
Too much of that.
Oh, yes. Misinformed is happening all the time.
Yeah.
And this is where the savvy, shrewd, wise, intelligent lawyer comes into play.
Yeah, that's how you make money.
So there's a different dynamic between an adjustable mortgage and a fixed rate mortgage in terms of making extra payments then. Is that correct?
Correct. The adjustable mortgage, when that rate adjusts, that's the only loan where your payment may change.
So if you make an extra payment with an adjustable mortgage, it's still 30 years, for example, but your next payment may go down because of the...
If the rate changed at the same time, your payment can go down.
I gotcha.
But I will tell you, probably 95% of all people do take fixed rates.
Can we have an example of what you just said? Because I think it's critical. We just said, for example, that you have a 5-year fixed or a 7-year fixed, which at that point, your entire loan will be recasted, recalculated. Right. And if you made extra payments during the first 5 years, then, for example, if you borrowed $500,000 and now in lieu of having $450,000 balance, you have $400,000 balance, then your loan will be recalculated on a premise of $400,000.
They're not recasting your loan; they're recalculating the interest portion. So the interest portion is going to be lower. The amortized portion allocated to amortize that loan out over the life of the loan, the 30 years, is still there. So your interest portion is now going to be smaller, which will affect your monthly payment. What you're talking about is recasting. They don't recast to the outstanding balance.
Okay.
Can you just clarify that?
So let's say your rate, you went to your 50-year anniversary.
Yes.
Your rate was 5%.
Happy anniversary, by the way.
Thank you.
What'd you get them?
I didn't get it.
You didn't get them anything?
What is it, linen?
Starbucks coffee?
Is that linen?
It?
What is it, 5 years? Linen?
Anybody know?
We don't know?
We don't know.
It's a dozen roses, some chocolate.
I think it's linen.
So on your 5th anniversary, the rate is 5%. It's going to go down to 4%. So the interest portion of your payment is going to be lower because there's less charge to that outstanding balance.
So if you can, pay more. As
Always.
a consumer,
one extra payment a year does a world of good. It's going to put thousands of dollars back in your pocket.
That's amazing. Okay, so let me go back to the second question that I had when we were talking about underwriting and pre-approval versus pre-qualification.
Yeah.
And that is this. Is the stated income mortgage, is it in existence now? Do they exist? Because we're talking about all this documentation. But
yeah. Are we going back in history?
They went away, as far as I recall, in the crash.
Right.
Have they come back?
There's kind of a hybrid situation out there where some portfolio banks, portfolio we talked about earlier, means the bank is lending its own money.
Right.
They're looking at the bank statement cash flow
Okay.
And it might be some of those people that don't have a traditional job.
Right.
That have a lot of flow in their bank, but they don't have the income on the books.
Right. So, for example, someone that's self-employed, someone that works in a cash business, someone that is maybe runs a restaurant or something like that, they may not document a lot of they may not show a lot on their taxes or whatever, but they have the cash flow in their bank. So there's some documentation. It's just a little bit
limited. You're going to pay a higher interest rate. Now, the trouble for the marketplace is that let's say the investors that want to take that kind of loan, they can't charge enough because there's all of these high-cost laws that forbid the risk rate to be charged.
Okay.
So that's not the same as in the old days where we had no income, no asset verification.
No, it's not. There's some kind of documentation. It's kind of a hybrid. Like I said, they're looking at the bank statement cash flow. It's not really prominent at all.
Okay.
But in some cases it's there for that really more sophisticated borrower.
So as a follow-up to that, I have to ask this. Do you see subprime loans making any kind of a comeback? And there was some sort of peculiar word they came out with that's not subprime loan, but they
non-QM.
Non-QM, yeah. Non-qualified mortgage.
Non-qualified mortgage.
Which is, what's that, like a new PC way of saying subprime?
Yeah, it's politically correct.
Yeah, okay.
We don't profile.
Right. But what is the non-QM these days? What is that?
A QM loan is what we've been talking about.
It's conventional. It's a qualified
conventional,
mortgage.
an FHA loan.
Right.
That's QM loan. It's qualified mortgage. Qualified meaning you have an ability to repay.
Okay.
So that's where it comes into place. Ability to repay is the traditional method of, we looked at pay stubs, we looked at the tax returns, we looked at the W-2s. A non-QM loan is if you're not meeting any of that criteria, it's not a qualified mortgage.
Okay.
So many banks are afraid because we don't know with all that happened what would happen if one of those loans fail.
Mm-hmm. With
the safeguards that are put in to protect the consumer. Can you even foreclose on a non-QM loan because of all the laws that were put in place?
Wow.
It's a tough marketplace.
Okay. So let's get into the credit.
But that being said, you can get a mortgage today. We all know that. The trouble and difficulty most people have is just supplying the documentation presented in a timely basis to get the mortgage. Okay. So you have to build up almost an FBI dossier file to get there and get the mortgage. Some people just are unwilling to supply all that documentation. But it's doable. It's accessible. Mortgage money is there. But the home ownership dream is able to be fulfilled.
Now you're referring to an 80% loan, correct? When you say conventional loan, you're referring to 80% because above 80% it becomes a high-risk borrower, right? With PMI.
You can get a conventional loan, but there'll be PMI, private mortgage insurance on it.
Right.
It'll be there. So that conventional loan still exists. There's just a little bit, let's say a surcharge, because you have to pay insurance on it, insuring the lender against loss.
Okay. So that makes sense. The higher the down payment, the lower the risk for the lender.
You can put down 5% on a conventional loan and get a mortgage.
God bless you.
And get a home.
All right. So I would imagine the one common thread throughout all these different types of loans, however, is always going to be credit.
Sure.
Because you can skirt around some things, but credit has to be verified.
Right.
What sort of credit these days is required for a QM or a conventional loan? What do Fannie Mae and Freddie Mac want?
Now, again, that goes to automated underwriting systems. In most cases, if your credit score is below a 640, your average credit score, middle credit score, the lender has an obligation to look at 3 scores and pick the middle. The middle score has to be around 640 for you to get that conventional loan. Less than that, you're probably not going to get a conventional loan.
640.
640. Now, the beauty of that is that if you've been with a good loan officer and they're spending the right time with you and going over everything, they could tell you over the next 6 months, Mr. Potential Homeowner, this is what I want you to do. I want you to pay this bill. I want you to fix that situation. I want you to get rid of these credit cards, or I want you to go get more credit cards. If that loan officer has this as a career, he's going to make sure that that client walks away knowing what they need to do over the next 6 to 12 months to get that home in the future.
Or they can refer you to a credit repair person.
Or a credit repair person, which, again, it might take a couple of months.
Right.
But you can affect that. It's not static. It's dynamic. We could work on it. We could help you.
It's like your weight.
That path. Yeah, you're on a journey. Your journey might not be where you thought it was going to be today. It could be there tomorrow or a year from now.
Okay, so given that, with that in mind, the fluidity, if you will, of credit scores, there is a concern among some consumers that they don't want to get pre-approved just yet because they're afraid that if they have their credit run, it'll lower their scores.
So
that's a myth, right?
Let's talk about that for a second.
Yeah.
You're a consumer. You want to go buy a house. You don't want anybody to know what you can afford. You want to walk into a person's home that you don't know and have given no information to buy that house. That's not happening.
That's not happening.
That's not happening. Your credit has to be run or should be run so that when you go out with assurance. Again, it's not a drama. It's not a mystery. And if you're a good shopper, you're going to go to maybe 2 or 3 people, find out who you feel comfortable with. And that being said, if your credit is run 2 or 3 times, it's not going to affect your credit score.
Really?
Your credit score will be fine.
Okay. What would it take to have an adverse effect on your credit score by having your credit run?
If you went out and shopped around 10 times.
In like
8
a week?
times in a week, yeah. Just rampantly had too many people run your credit, it could affect your score, absolutely.
But if you have your pre-approval updated every 30, 45 days, every 30 to 60 days, is it going to harm your credit?
It won't harm your credit. And updating a pre-approval might not involve rerunning your credit. It might just involve updating your pay stubs, looking at your bank statements. That's having a relationship with your loan officer and with your real estate agent. And hopefully by that time with an attorney that could properly advise you.
Don't forget
you better have a relationship with the attorney.
Absolutely.
Because I don't want to have a relationship with the attorney.
So looking at all that and holding it together, you as a consumer choose your team. You want to choose the best team possible, the one people that you feel comfortable with. Are you building the Mets or are you building the Yankees? You building the Nets or the Knicks? Take your pick.
The Nets and the Knicks is a rough choice there.
Choose the top draft picks. Don't choose the bottom of the barrel. And that's when you look at a loan officer as a consumer, look at the loan officer in the eye. Look at them. Do you feel comfortable? Look at the real estate agent. Do you feel comfortable? You're allowed to say, no, I'm not comfortable. Move on to the next one. Build your team.
Let me ask you, do you think that some people think that the pre-approval letter is interchangeable? In other words, if I have a pre-approval letter from Bank A, I can go to Bank B and use it there or vice versa. And the second question is, it's a compound question. The second question is, if somebody...
an attorney. Compound question from the attorney. Go
compound
figure.
or complex?
Both.
Okay.
If you go to Bank 1 and you are pre-approved, does it mean that, oh, don't worry, you'll go to Chase, you go to Citi, you go to wherever it is, and you'll always be pre-approved?
So if you bought a Chevy, would you go to Ford for a repair?
No.
Okay, so if you go to one bank as a consumer...
If you're dumb.
That's the bank. That's even dumber if they fix the car, too.
Yeah.
So if you go to a bank, you're with that bank, that pre-approval stays with that bank and with you. If you want to go to another bank, that bank should do their due diligence on their own and issue you a new letter.
So it's not interchangeable?
No, it's not interchangeable.
It's for per bank, for the bank.
Sure.
And the criteria of that particular bank.
Yeah.
And if somebody says to me, oh, I have an account at Chase, so don't worry about it. Chase will definitely approve me.
I hear that sometimes. I think
we hear it all the time.
So does it mean? So my question is, does it mean because you have a relationship with a particular bank, then the chances are of you being pre-approved are much higher, and therefore, as a lawyer, I should recommend, or as a real estate agent, he should recommend, yes, go to your bank.
Sure. You had a compound question. I've got a compound answer.
Okay, go ahead. Shoot.
The first answer is that the credit, the income, and the assets have to be there. No one at any bank is a mind reader. They've got to do their due diligence and look at you as the borrower and make sure that they did their due diligence. So just having a checking account or a credit card doesn't mean the bank's going to approve you.
Okay. So
then the second part is that you want to also go to the specialist. Just like people go to a real estate attorney, you want to go to a mortgage banker. Chase and Citi and Wells, they're all good. But when it comes to that, we are the specialists as mortgage bankers at United Northern. So we're going to make sure that we do one thing and we do it the best way possible. We are a master of that particular trade.
So you talked about looking the loan officer in the eye.
Yeah.
You cannot do that with an internet lender.
No, you can't. That's why
so accountability is a thing.
It's big.
By the way, I do have to tell you, in terms of compound and complex questions, the attorney's job in this show is to ask the compound and the complex questions. I ask the compost questions.
Yeah,
that's how this works around
here. You've been sitting on the questions for a while?
Yes, sir. We are here with Don Giorgio of United Northern Mortgage Bankers. This is Real Estate Talk Radio on WOR 710 at the iHeart Radio studios. We broadcast live every Sunday morning, and we will be right back.
Every loan has a story, a family, and a dream that fuels it. My name is Jacqueline Sendra, mortgage loan originator number 39117, specializing in first-time homebuyer financing and an array of mortgage products. We recognize the importance of competitive rates and a custom-tailored mortgage loan to suit your needs. United Northern Mortgage Bankers Ltd. celebrates over 37 years of mortgage banking success. Allow us to help you achieve your dream of homeownership by reaching out to me today at 631-478-2706. Again, 631-478-2706. United Northern Mortgage Lenders Ltd. NMLS number 7230 is an equal housing lender and a licensed mortgage banker located at 3601 Hempstead Turnpike, Suite 300, Levittown, New York, 11756, New York State Department of Financial Services.
This is Paul Oster, the nation's credit repairman, and I want to help you improve your credit. As the CEO of Better Qualified, I've helped thousands of people over the past 10 years. I'm the credit expert for Fox Business News and all the major networks. I'm a certified FICO Pro that uses the consumer laws to help delete negative information off of credit reports. We have a debt elimination program that focuses on the laws surrounding collections, judgments, and charge-offs. You could be entitled to up to $1,000 per violation. Call now for your free credit consultation. 888-533-8138. That number again, 888-533-8138, or visit us on the web at betterqualified.com.
Hi, this is Tom Marinaro, the president of Residential Home Funding, a top East Coast mortgage company. Now is the time to buy a home before interest rates go up. Lock in with a low rate today, or turn your current home into an asset by cashing in on its equity. Why rent when you can own? Why not get cash out of your home now? So call me right now at 1-800-636-LEND. And as a bonus, if you call me right now, I will waive all of my lender fees. That's right, zero lender fees, saving you thousands of dollars. This offer is for purchasing or refinancing a home. Call me and learn more at 1-800-636-LEND. Residential funding is part of the New York and New Jersey Departments of Banking and Insurance. Our NMLS number is 36152. The number once again is 1-800-636-LEND. That's 1-800-636-LEND.
RETalkRadio.com is your portal for cutting-edge information to give you an advantage in the competitive real estate market. Now, back to Real Estate Talk with Victoria Rivadeneira.
I have to say that Victoria Rivadeneira has the best shoes in radio, and I have the worst shirt. This is J. Philip Ferrando with Lior Aldad and Don Giorgio of United Northern Mortgage Bankers. We are talking about Fannie Mae and Freddie Mac mortgages. Welcome back. And we're talking now about the fact that there have been some changes with the government-sponsored entities.
Massive changes going on.
Massive changes. And this is where we're going to get into educating the public a little bit.
Sure.
Okay. So even though it's not a compost question, I have to ask, what are these changes that we should expect?
We should expect people don't ever wear plaid shirts again on radio.
Yeah,
That's
never do that.
thing.
No comment.
I dress for comfort. What can I say?
Right. Not compost, but comfort. The way mortgage lending is working today, there's data. Your file is data, and all that data gets compiled. And over time, that data gets bigger and bigger, so it's allowing us to have a better feel for who the mortgage borrower is. One of the biggest things that's occurring is the appraisal or property inspection waiver, meaning that if the property was appraised in the last year for some other reason and Fannie Mae or Freddie Mac has that appraisal, and you're buying that property with 20% down as your owner-occupied property with some other conditions, there's no appraisal necessary. So you're saving $400, $500, $600 perhaps on that particular deal.
Okay.
So the actual appraisal is waived?
Provided that Fannie Mae or Freddie Mac has an appraisal in their portal from a previous deal.
But what if the appraisal last time was for $400,000 and now you're trying to spend $550,000?
Exactly.
You're
not getting it.
What about? Okay. Whoa, that's a huge change.
Well, it's a great change. We don't have all the answers. I'm right now just the messenger, and we're going to see how this works out over time.
Okay.
But because it's data, they could track market trends, appreciation trends, depreciation trends. They could track market stability, inventory, and supply. They feel comfortable and confident that they've got this down.
But I do most of my practice in New York City, and we have transactions of co-ops and condominiums and apartments. yes, I know that the appraisal is worth a certain amount at a certain time, but the apartment upstairs can be sold next week, and the apartment beneath can be sold in 2 weeks from now, and that totally affects and changes your appraised value.
Well, we're talking about a property inspection waiver, which means that you don't need to do the appraisal. It doesn't mean that you can't. So when that loan is done and we decide up front what to do with that loan, how to put it into the system, the AOS system, we could look for the waiver, or we could just say we don't want to do that because we feel we need a new appraisal with new value to be able to substantiate what we're doing today.
Okay, so in other words, it sounds like before we get panicked.
No panics yet.
If we are going to try and prove there's some appreciation, like, from 400 to 550 9 months later, then they wouldn't necessarily invoke this waiver. That is when they would actually say, we should get it approved. The waiver would be if it's going to sell for the exact same price.
Yeah, the property value didn't go up for some reason or another.
Okay.
And it's so close to the previous appraisal that it's warranted to go for the waiver.
So, Don, do we have access, or you as the mortgage banker, do you have access to that appraised value in order to evaluate on our own accord between what's in the system versus what the contract price states?
This was just released this past week. I have it in front of me.
Aha.
That's the paper it's on.
That's the paper it's on.
August 18th. We're all learning as we speak.
2017.
2017, August 18th.
Uh-huh.
If I was a guessing, I apologize if I caught you off guard, but if I was a guessing man, right, I would say that let's assume you have access to that appraised value, and that appraised value shows you, 7 months ago the apartment was appraised at $700,000, and you have a contract of sale for $710,000, you can ask for the waiver.
Correct.
But if your contract of sale says $1 million, then you would probably advise your client, well, you know what? It shows in the system of 700. Let's try to see why it appreciated so much and try to justify the appreciation on the basis of a new appraisal.
Sure. You could still go there and look for that value on a new appraisal.
Right.
Or we could, like I said, go there and say, okay, we don't want it. We know it's going to be relatively the same. As the lender, we're probably going to be able to look and see if there was a previous case on that particular property. Because the appraisal is now going to follow the property as opposed to it being about the borrower. In this case, it's going to be about the property itself.
Another thought is that if the waiver gets rejected, hypothetically, you can back up and go to your actual appraisal, no? I'm presuming.
You can go get a new appraisal, yeah.
Okay. So what would be the second change?
The second biggest change is that everyone understands the cost of living has gone up.
Yes.
It's more expensive, especially live in New York. I'm sure your Starbucks cost about $5.50, if not more.
Yeah.
And that being said, Fannie Mae now announced that they're going to allow the amount of debt you have against your income to go up a little higher, where it was traditionally where you couldn't spend more than 45% of your debt towards your mortgage payments, your credit card debt, and your expenses. It's going to go up to 50%.
Wow.
So you could have 50% of your debt allocated towards, 50% of your income allocated towards debt.
So the debt-to-income ratio is essentially rising by 5%.
Yeah, that is a massive change.
That's
got people jumping out of windows maybe. I don't know at Fannie Mae, but that's what they did.
Okay. So if I make $10,000 a month.
Correct.
Just because I like to use round figures.
Your gross income.
Yeah, that would be
because we work with gross income.
Yes.
It would be gross if that's what you made.
Yeah. If I make $10,000 a month, the bank in years past, prior to August 17th.
You got a raffle paper.
Yeah. I'm not that good at it. Prior to August 18th, 2017, I couldn't have my mortgage plus my other debt be more than $4,500.
Correct.
But now they will allow my mortgage plus my other debt be
equal to
$5,000.
$5,000.
$5,000. Do you think that student loans is a factor in that kind of a thing? Since
I
student
think a
loans
lot
are
of
such
it does have to do the debt, and that's a whole separate animal with student loan debt and how high it's gotten and how long it takes people to pay off their student debt.
Yeah. Okay.
Because traditionally you could waive the debt and not count it. Now you do have to keep the debt into their ratios.
Okay. Is there some you said this might make some people nervous. It makes me a little bit nervous. Is there some risk involved? I mean, is there some, people a little worried about this?
I'm not sure if they're worried. They published it, so I'm sure their statistics are telling them it's going to be okay. But I'm looking at it and saying, okay, you're pushing the envelope a little bit again.
Okay.
A little further. The more you're making people stretch the dollar, the harder it is, and the easier it is to make a mistake or stumble.
Okay. Gotcha. So, fair enough. So we'll go from the thing that makes us a little tense, perhaps, some of us,
Yeah.
to the thing that we all like. This is the third change. What is the third change over
major change?
Major change. Yeah.
The process of mortgage financing, because there is so much data compiled in a mortgage application itself, that using these automated systems, using these algorithms, and because of all the electronic communication, there's going to be the opportunity for a lot of mortgages to be streamlined in their documentation.
Uh-huh.
So that would mean the average salaried borrower that just has their money in a bank, nothing difficult, fairly generic, vanilla,
Okay.
not Rocky Road
Right.
or Pistachio, might not have to produce a lot of paperwork. It might be very streamlined where you might not need to actually come up with the pay stubs or the W-2s because of electronic verifications that come into play in order to document a mortgage.
That is huge, in my opinion.
Yeah.
So one of the industry publications, Inman News, the publisher, Brad Inman, talked about something called the latte mortgage years ago,
Yeah.
where it would be a streamlined process where technology would allow us to marry different platforms to enable people to not have to stand on their head and jump through hoops in order to get. So is that day coming? Is Brad a futurist?
It's about here.
He made the call?
Yeah.
Okay.
He made the call. It's happening. Our technology is catching up to our communication so that all this data, when you work at a place and you work at AT&T or you work at Verizon, you're just a salaried worker like all of us, we get a W-2.
Right.
That's pretty much standard. So when you're in that standard picture, I didn't use profile, when you're in that standard picture, you can be able to get that mortgage with minimal paperwork and minimal pain.
What is the term that's used for this?
It's more about the lenders and how the lenders present it to the public. It's called day one certainty for lenders.
Day one certainty.
Yeah.
Boy, I like how that sounds.
That sounds like totality, doesn't it?
That sounds better than dating. That's because,
right. You're getting married after one date. Is that day one certainty?
Whoa. I mean, at least agreeing to a second date,
Right.
That's pretty good. So day one certainty is the term they're using.
Yeah.
Okay.
That's more for the lenders to say that if you use this portal and this methodology of documenting a mortgage, that we are 100% confident that that client's going to make their payments back.
Okay, so
So the lender's off the hook for ever worrying about that mortgage, and Fannie Mae is so confident that that mortgage will never default.
Okay.
For the most part. I'm paraphrasing.
Well, sickness, disaster, economic
illness,
something like that,
right.
But
nothing catastrophic.
Okay, so assuming all things being equal, that people just continue to work and live their lives, that the prognosis, the sustainability of this loan yields the bank to say thumbs up.
Thumbs up and minimal paperwork to get your loan complete.
Okay, and this is just for Fannie Mae and Freddie Mac conventional loans. This is
no,
not
just
for,
Fannie Mae.
Just Fannie Mae.
Yeah.
Because Fannie Mae is kind of a little bit more aggressive.
Fannie Mae and Freddie Mac are a little independent. Victoria is Fannie Mae. You're Freddie Mac. Or it's the other way around.
I think
Fannie
I'm the crazy one. Yeah,
you're Fannie Mae.
I'm the nut.
Yeah.
All right. So this is a concern in that all of us are a little once bitten, twice shy, those of us who are old enough to remember the crashes.
Sure.
Okay? And it is my observation, you can disagree if you wish, but I think you'll probably agree, Lior, that the one thing that always seems to tank the market when it has been adversely affected, it isn't war, it isn't change of administration, it isn't domestic terrorism, it has always been a breakdown in the financial markets, and what has always been the precursor to breakdowns in financial markets has been the liberalizing of mortgage lending to the point where to the absurd. And while this is not absurd in the least, is it not the beginning of a slippery slope where the continued relaxation of lending standards eventually in 5 or 10 years may have us in another bubble?
I'm a little concerned about that myself as a lender because we went through a lot of grief and agony for the mistakes that others made. I'm still standing 38 years.
Yeah.
I'm still here. We do the right thing. That being said, we have to work with the tools that were provided and how we're told to use those tools. I feel that although it is relaxing it a little bit, there's so many safe benchmarks in place where in the past what we did have was a lot of fraud. Let's be honest.
Yeah.
There was a lot of making up of documentation, whether it might have been someone on the lender's side or it might have been even a consumer with pay stubs, with W-2s, with fraudulent tax returns. There's so many safeguards and compliance that I think I'm confident we'll be able to sustain these loosening of the guidelines. That
I think the intent is to entice and push forward additional growth in the lending industry, perhaps because interest rates are about to rise a little bit or because of the economy overall. But whatever it is, they're trying to add some fuel and get more transactions happening.
Well, some of this sounds great. They're like common sense.
Sure.
It's just that if you have in a vacuum and over here something that seems reasonable and something over here that seems reasonable, you put it all together and whoa, right?
Right.
So like little. So
it's a little tweaking.
So we worry.
A little tweak is not a bad thing,
Like
especially
your
on
mother.
a Friday.
A little tweak.
Yeah.
I think it's a reserved worry.
Cautious optimism.
Yes.
Guarded optimism.
Guarded optimism. Would you say?
Yeah, guarded optimism. But the technology that's now involved is, I think, going to be able to protect, and we have Dodd-Frank, which will protect the country, the industry, and the public.
Okay,
properly.
I'm going to ask you an unfair question. Okay?
Sure.
Dodd-Frank, good law or bad law?
Parts of it are very, very good. Parts of it are just unfairly distributed.
Okay.
So I think it's a good law to protect the consumer. I think there are parts of it that need to be ratcheted back and some parts that allow exemptions of the largest banks, believe it or not, that are perpetrating the biggest issues with regard to consumer problems.
With a minute left, what is your long-term outlook?
I think that we're going to be on a really good wave forward. Appreciation rates are not that bad, so I think we're going to be very safe, stable. Interest rates are going up, as Lear said, but not dramatically. So we're going to be in a good ride for many years to come.
Good to hear. Don Giorgio, president of United Northern Mortgage Bankers, I thank you for joining us on Real Estate Talk Radio, heard every Wednesday at noon on Facebook.com and on retalkradio.com on a podcast. You can also hear us Sunday mornings at WOR. And I want to thank you also, Lior. We'll see you soon.
Thank you.
I hope everyone has a great day, and it has been a really good show to educate the public.
Absolutely. Thanks for having me.
Okay.